Well, Wall Street doesn't think the Fed fight will be over anytime soon. Goldman Sachs says it is now expecting the Fed to raise interest rates another 3 times this year, each by 0.25%. These fears have rattled the markets, with the Dow on track for a third consecutive week of losses. And as I mentioned, you guys, Bank of America also joining in this morning, saying the same thing. The PPI report yesterday was sort of the straw that broke the camel's back, as it were, when it comes to Goldman Sachs. Their note was based on PPI, that is input prices, wholesale prices being higher than estimated. And they said that's why they had to raise their ending Fed funds rate target. What's interesting about all of this, of course, is that the Fed has been saying this, right? So we kept asking the question, are the markets going to come to the Fed, or is the Fed going to come to the markets? And it seems as though we have our answer. The markets are going to come to where the Fed has been.
Yeah, saying no salvation from inflation in this note. And one of the takeaways, I mean, look, I love the rhyme scheme that some of these notes have at the end of the day. But adding that 25 basis point rate hike at the June FOMC meeting, that also brings their terminal rate to about 5.25% to 5.5%. You kind of couple that with what we had heard from even James Bullard and saying that further hikes would lock in disinflation. But it seems that the more aggressive tenor seems to be the, at least Fed speak, prevailing thought over the course of this week.
Part of being a successful investor is tying a lot of different pieces together. And over the past 7 days, or since that last Fed meeting, you have had Fed officials, to your point, Julie, come out here saying we're likely to remain hawkish for a little bit longer. The next shoe to drop here is now you're seeing Wall Street finally start to come around to this notion, and you're seeing stocks react accordingly. Now that hot tech trade probably done for the time being. Tech stocks don't like any indication of higher interest rates. And if you do not tie these things together, essentially you are a lazy investor. And maybe you shouldn't, in fact, be successful, because you are now having, I think, the likelihood that resurgent inflation, just to use Michael Hartnett's term in his note this morning, resurgent inflation, another rate hike, lower potential returns for stocks, not just tech.
Or you can just buy and hold, and you don't have to worry about any of that stuff.
Well, if you have a Warren Buffett time horizon of essentially buy and hold forever, sure, you don't have to worry about these things, but that's not realistic for a lot of people on our platform right now. They are trading these markets, and I think they missed a lot of signals.
You know, for the other side, if somebody is saying, you know what, I'm just going to buy and hold and just sit on it for whatever my time horizon is, that does put other areas of spending in focus for a household. And we just saw some data from the New York Fed come out yesterday where, of course, there is good debt and bad debt. And some of that debt for the New York Fed, at least that we had seen come out, saw credit card spending over the fourth quarter of 2022. And overall spending, in aggregate, this debt had reached levels that we hadn't seen since before the pandemic, and even eclipsed some of those levels. So even though your home debt is probably good debt, as it would be considered, there's still a lot of tapping into credit and that debt that is more impactful and perhaps burdensome in this immediate term to really just combat inflation to the best ability possible. But then on the other side of this, where do you start to pay that down, and how does that impact some of the subprime and near prime consumers in the near term, and impact them over a longer term as well as they try to rebuild? Well,
and this brings up a good opportunity to remind people why it matters when interest rates go higher, right? If the Fed is raising another 0.75 point, at its next few meetings, interest rates go higher. That obviously, in most cases, means it will cost you more when you're borrowing to buy a home, to buy a car. If you're saving money, you're probably going to earn more on that money, right? If you're putting your money in a CD, in a savings account, it doesn't necessarily mean a huge increase, but it means you're earning something on your savings, whereas 5 years ago, you weren't earning anything on your savings. So there's good and bad, obviously, when you look at these different changes.